To bootstrap or not to bootstrap? That is the question. Or do you bootstrap or do you fundraise from, sharks like myself? Today we're going to dive into bootstrapping, pros, cons. We're going to talk about fundraising, pros, cons. And then stick around to the end and I'll share a story about two entrepreneurs and the argument they had at one of our conferences on stage in front of all of our attendees. That was pretty awesome about the pros and cons of both. So first of all, what is bootstrapping? Well, bootstrapping comes from this term to pull oneself up from their bootstraps. I mean, you can try this right now. Grab your shoes and try to pick yourself up by picking up on your shoes. Sounds pretty much impossible, right? Well, it is. And that was the idea. It was this idea of like building something from nothing is basically impossible. It's really hard, blah, blah, blah. And yet, a lot of entrepreneurs figure out innovative ways of creating stuff out of nothing. In the venture capital world, though, and in business, bootstrapping really refers to starting a business without raising money from outside investors. And the reality is that most companies start this way. They start from people's own personal savings accounts, or maybe they do raise some money, but it's from friends and family. Like, Uncle Joe gives, you a loan for $10,000. So you can start, that restaurant concept that you think is going to take off. There are a lot of ways that, entrepreneurs think about bootstrapping. In general, though, the difference between bootstrapping and traditional fundraising as it relates to venture capital is that you're not going to venture capitalists and raising money and then having them on the board and giving up control and a lot of those other things and really getting on what we call like the venture capital gravy train or addiction. It's really about like, hey, I'm going to build this myself. And I'm, in many cases, these businesses, they grow slower, but they're more focused on profits and control. And there's some real pros and cons. So let's talk about some of the pros of bootstrapping rather than raising money from venture capitalists. One, when you bootstrap a business, you control the business. And so you decide when you want to grow, when who you want to hire, what types of products you want to build. If you want to sell the business, you can decide to sell it whenever you want. If you have people that are coming to buy it from you, you don't have to wait for some venture capitalist to feel like they're going to get a good return and let you sell the business. You just have a ton of control. Another benefit of bootstrapping a business is that you own all of it. So when you do go to sell it, you get all of the benefit, you and your co-founders, right? If you have any. And so not only do you get a lot of control, but you get to enjoy 100% of the fruits of your labors, if you will. So, that's another great benefit. The other thing is that a lot of businesses don't need venture capital. They're not a good fit for venture capital. And so you don't have to worry about going out and raising venture money. It can be challenging because you have to find other ways to do it, but that can force you to be really thoughtful about the business models you're pursuing. And you can always bootstrap and then change your mind later and raise venture money. There's a great company here in Utah where I'm located called Pluralsight. Now, Pluralsight today is a publicly traded company. You can look them up. But they were like the, I think, 19-year overnight success everybody used to joke about. They started their business just doing consulting work. So for them, they bootstrapped because they started the business when they got their first client that they were consulting. And then they started building like some training modules from their consulting practice. And then they started building this library of training videos. And then that eventually morphed into what Pluralsight is today, which is this technology platform that provides educational videos primarily for technologists working at different companies to help them level up their game and learn how to do various types of coding and infrastructure building and so on and so forth. But they had to be profitable basically from day one, and they were profitable for a long time until they got to a point where they're like, hey, there's something here. We think we can build this into a scalable platform, and ended up raising money from some really great venture capitalists later on. So bootstrapping doesn't mean that you have to forego fundraising forever. You still have a lot of optionality. Whereas if you start fundraising, once you're on that fundraising track, it's really, really hard to go back to more of a bootstrap mentality. You basically have to buy out your investors, which can be very costly, if not impossible to do. Now, there are some definite cons of bootstrapping. And to me, the biggest con is that your most valuable resource in this life is not money, it's time, right? And with bootstrapping, invariably, it's going to take you longer to accomplish the same things than if you had cash in the bank. If you have cash in the bank, you can go hire a bunch of people to do things and really accelerate things a lot faster. You can spend money on marketing to get customers faster. You can, spend money on your brand and build a bigger brand faster. You can spend money on product development and build a much bigger, richer, feature-rich product than you could have without funding. So funding can give you a lot of things that really accelerate your business. If you looked at Pluralsight, it took them 19 years, plus then it took them another 5+ years to get the business to the point where it could have gone public. Imagine they had started day one with that venture funding, and then they could have accelerated, and instead of taking 25 years, they took 10 years to accomplish the same amount of things. Now, at that point, they would have owned less of the business, they would have controlled less, so there were some definite cons there, right? But nonetheless, they could have done it faster and maybe started another business and done even better on that, or just enjoyed more years of their retirement. There's some other cons as well, you're always, you don't have partners to hold you accountable. You don't have other sources of capital usually. And so, if you hit a tough spot, it could mean the end of the business because you don't have other people around the table and with a vested interest in making sure you succeed. When a venture-backed company hits a bump in the road, oftentimes they can go back to their investors and raise more money to keep the company going. A bootstrapped business oftentimes can't do that. They hit a bump in the road and it usually means the end of the business. So, some definite cons to bootstrapping. Let's talk a little bit about fundraising, particularly from venture capitalists. So the biggest pro is the corollary to the biggest con of bootstrapping, and that is the ability to move fast and build something big in a relatively short time period. So if you really value time more than anything else, then fundraising can make a ton of sense because you can go raise a ton of money, build your business, grow it, make it really big, exit your business. And even though you got a smaller piece of the pie, hopefully you made the pie really big, so much bigger of a pie, and you got to eat that slice of pie a lot sooner than if you had bootstrapped. And those are really the benefits. Time is money. And the longer you wait, the less your money is worth at the end of the day, right? If I'm young, I can enjoy a lot of that money to a greater extent than I can when I'm older and my body's maybe not in as good a shape and I've got lots of other priorities pulling at my time and attention, et cetera, et cetera. So there's some definite trade-offs. The other pro of fundraising is that, like I said, with bootstrapping, by raising additional capital, you have people that are going to hold you accountable. They're going to push you. They're going to, incentivize you to do a great job on their behalf because they're reliant on you to do a great job. They're going to be there when times are tough, hopefully, especially if you picked good investors to be along the ride with. They're going to be there to help support the business either through emotional and mental support, fundraising, intros to other funds, and introductions to other providers. In many cases, they can help get you to a soft landing by finding a strategic acquirer that'll come in and buy the business. So even in that case, you're able to find a buyer by bringing in these people. Sometimes, many times, good investors will bring sector expertise and additional guidance and advice and mentorship that can be really helpful and spell the difference between success and doom. So a lot of strong positives for raising venture capital. There are some downsides though, and you should be very aware of these downsides when you get into bed with venture capitalists. The first is, once you take venture money, you are in it for the long run until the VC gets a good return, right? The VC is putting money in because they're hoping your business becomes worth tens of times what it was when they invested. They want to generate a huge return, which means usually that you're going to be in the growth at all cost mode. You're raising more money to spend on marketing to drive revenue so that you can raise more money, so that you can spend more on marketing, so you can drive more revenue, et cetera, et cetera. And you get into this this flywheel hopefully this flywheel gets bigger and bigger and you end up being really successful because you're able to raise a lot of money and grow really fast and generate a ton of revenues and establish yourself as a monopoly and a dominant player in your space. The problem is that sometimes companies shouldn't be venture backed. And so they start raising all this money and then they hit this wall because maybe their market's not big enough or because their business model isn't the right kind or what have you. And what would have otherwise been a successful business if it had been bootstrapped or if it had raised less money no longer can achieve that because so much money has been poured into it that it has no place to go either other than to either succeed or fail. The other thing is that venture capitalists, even if they don't take a majority of the business, which is very rare, usually venture capitalists want a minority piece of the business, they're still going to put typically a lot of provisions into the terms of their investment that give them almost all of the same control as though they had a majority ownership. They'll put in things like, we have a right to decide when you sell the business, when you raise more money, when you spend money, when you hire more employees, if you merge with another company, when you go public. All of those things can be controlled by the venture capitalist. And so, that's something you need to be mindful of as well, that sometimes it's costly, not just in terms of the equity you're giving it, but also in terms of the control. The last thing is that, bringing on venture capitalists can bring more money around the table, especially if you hit a bump in the road. You'll also be dependent on those same venture capitalists because typically your company is burning a lot of money to grow really fast, and so you're not generating profits. Like a bootstrapped business usually grows slower, if at all, but is generating profits or is profitable, and so it can kind of dictate its own future. Whereas if you're burning money and you're unprofitable, you are always reliant on venture capitalists. And if you either hit a bump in the road or the broader economy hits a bump in the road, you could be in a tough spot. I'm looking at some of our portfolio companies right now, fantastic businesses, outperforming plan, doing really well. But if you look at their peers in the public markets, they're trading massively down. And so even though the company's doing well, they're not doing well enough that they're generating profits. And so they have to go back out and raise more money. And the environment today is really tough to raise money. And so they're having a hard time getting the same valuation that they would have gotten even just a year ago because valuations across the board are down. But to wrap up, I want to tell you this story. So at my prior fund, we used to run this conference every year. It was a great conference. It's professional level. We bring in amazing entrepreneurs and VCs from across the country for a couple days where they would educate students from around the world on venture capital, private equity, entrepreneurship, and so forth. It was a fantastic event. But this one year, we had this panel, and it was great because we had these two really great entrepreneurs. One worked at a company that was raising tons and tons and tons of money, but going after like a huge problem in a huge space. And the other entrepreneur was this kind of crazy but brilliant entrepreneur that was like, yeah, I'm just going to raise a few $1,000,000 for my startup. I'm not raising a ton of money. I mean, he could have raised a lot of money, but he purposefully was like, I'm only going to raise a couple $1,000,000. I'm going to basically bootstrap this the rest of the way myself, and I'm going to get to an exit, even if it's a small exit. And that's exactly what he did. He ended up raising a few $1,000,000, ended up selling the business for, $60 to $70 million. He owned the majority of it, so he pocketed all that money. It was great. He did it relatively quickly in the span of like 2 or 3 years. And then the other guy owned, a small piece of the business, like 5%. But that company was ended up being a multi-billion-dollar company. And what was hilarious is these two guys are on the panel and they're just fighting with each other back and forth. And one's like, no, it's better to raise less, own bigger piece of the pie, right? Even if the pie is relatively small. And the other guy's like, whatever, you're crazy. Like, the best is to raise a ton of money and build this thing into a massive pie. And even if you get a smaller piece, like, you get a smaller piece. To the point that they both stood up and started yelling at each other on this panel. So you can see like how passionate people can get about this. And for me, like, it was a really insightful example of like, one, how passionate entrepreneurs can feel about all of these different conflicting things, right? Like whether it's your time, it's control, it's your relationship with your VCs. It's like the impact you want to have on the world. I think there's more to life than money. And for some people, that's like prestige, or it's having an impact on the world. And it's like, you know what? Even if I end up making a little bit less money, if I could bring this product or service to market and like serve so many people and help like change the world because my company exists, like that's worth it to me. Like, all the more power to you. Anyways, I hope you enjoyed this video and it was helpful as you think through, do you want to bootstrap your business or do you want to fundraise? And some of the pros and cons related to it. If you like this video, check out my other one. What are the pros and cons of crowdfunding? Thanks.